make no friends in the pits and you take no prisoners. 1 minute you're up 500,000 in soybeans, and the next, boom, your kids don't go to college and they've repossessed your Bentley. Are you with me?
The revolution starts now.
We have to pass the bill so that you can find out what is in it.
Turn those machines back on!
You are about to enter the Peter Schiff Show.
Show me the money!
If we lose freedom here, there's no place to escape to. This is the last stand on earth.
The Peter Schiff Show is on.
I don't know when they decided that they wanted to make a virtue out of selfishness.
Your money, your stories, your freedom. The Peter Schiff Show.
Okay, well, we've had a pretty good relief rally in the stock markets over the last several days, ever since we got a truce in the trade war, or, maybe more appropriately, a surrender than a truce, although that's not the way the Trump administration is promoting this so-called win. But when you strip out all of the jargon, that's basically what happened. I mean, Trump defused the bomb, but it's a bomb that he set. And the fact that he defused it has caused investors to enthusiastically buy stocks. I suppose people who might have taken on short positions have covered those short positions. And we've had a pretty big relief rally. In fact, if you look at the markets have pretty much wiped out all of their post-Liberation Day declines, and we're not that far below all-time record highs. The S&P is only about 4% below its all-time record high, which was a very high level of valuation, excess valuation. Nasdaq has recovered. It was down even more, quite a bit more than the S&P. It was in a bear market, and the Nasdaq is only about 5.5% below its record high. Dow, hasn't done as well. It's had a few problems with some of the components there today. United Health, not just today, but all week. And that's been weighing heavily on the Dow. That stock's down like 50%. So the Dow is off about 6% from its record high. Russell 2000, though, that is the weakest of the indexes, even though it's come off its lows. And remember, that index was down better than 30% or close to 30%. I forget the exact amount. But it's 15% below its record high. And again, the Russell 2000 is the index that is most reflective of the domestic economy, because you don't have all the multinationals, you don't have the big tech there. And so that, I think, tells a better story about what investors are expecting for the economy. The reality is they're expecting too much, because I think the economy is going to be a lot weaker. Yes, we're not going to have the worst case scenario. The 145% tariffs aren't going to stay in place, or even anything close to that on China. And I doubt the reciprocal tariffs that were unveiled on Liberation Day on the rest of the world are going to come back. I mean, it seems to me that what Trump is aiming for is about a 10% tariff on most countries, and maybe a little bit higher than that on stuff coming in from China. So it's in and of itself, right? It's not going to do much about the trade deficit. Trade deficit might shrink a little bit as a result of the tariffs, because imports will be more expensive. And so by definition, if imports are more expensive, we should import a little less. But that is going to have an effect on GDP, because so much of GDP is consumer spending. And consumers are going to spend less. Now, they might not spend less. They're certainly going to buy less. They just may pay more. But real spending is going to go down because of the tax increase. But yes, it's not going to be the nightmare scenario that it might have been had Donald Trump actually, stuck to his guns and kept the tariffs on. And with China, yes, maybe there'll be a little bit of a bigger dent because the tariffs are higher. But most of the products that are coming in from China are so much cheaper than what we could buy, domestically, that even if they're 30 or 40% more expensive, they're still going to be a bargain as far as Americans are concerned. Yes, they're going to have to pony up more money, which is going to be a problem considering how broke most Americans are and how heavily indebted they are. But trade is not going to completely grind to a halt, which is what the markets were bracing for when the tariffs were 145%. And it was 125% going in the other direction. So the markets had this relief rally. But I think investors are missing out on the big picture here because the tariffs aren't really the problem. I mean, they were a problem, but they're not the problem. The real problem is the trend of de-dollarization and the dollar's status as the world's reserve currency in jeopardy, because we have certainly brought the dollar status to the forefront, I think, in a bigger way than Biden did with the Russia sanctions. I mean, that was certainly a slap in the face, an alarm bell, warning to the rest of the world. Hey, you got to get out of dollars because that is, your vulnerability. To the extent that you're dependent on the dollar, you leave yourself open to U.S. retaliation in the form of sanctions. And so that sent the message that was received loud and clear: hold dollars at your own peril. But I think what Donald Trump has done has really, taken it up quite a few notches by threatening all kinds of tariffs on countries. And, to the extent that you allow yourself to export so much to the United States without importing, and you have these huge trade surpluses, and you therefore are obligated to accumulate dollar assets, that you leave yourself vulnerable, not only to the tariffs, but to a potential default. Like I mentioned on a previous podcast, where there was a discussion of a selective default on foreign holders of our treasuries rather than domestic holders, who obviously, could vote and would not be too happy about, not getting their money back. But the Chinese can't vote in our elections. And so I think that this trend is now accelerating to get out of the dollar, and not just the dollar, but dollar denominated assets. So bonds, stocks, and in fact, the stock market has recovered, all of its losses, but not the bond market. On Liberation Day, the yield on a 10-year treasury was under 4%. Today, it's almost 4.5%. In fact, yesterday, it closed at 4.54. We had a bit of a rally today in the treasury market. And so the yields are back below 4.5%, but they're not that far below. We're at 4.44 on a 10-year. So hardly any of the loss has been recovered. Same thing for the 30-year. 30-year was below 4.5, and now it's almost 5. It closed at 4.9. It was, I think, 4.97 yesterday. And so the relief rally in the stock market did not spill over into the bond market. And that is a huge vulnerability, not just for the U.S. economy, but for the stock market rally. Because if the bond market really rolls over, if we break decisively above 4.5 in the yield on the 10-year, which is breaking down. Remember, that's when Trump initially paused the first round of tariffs, not the Chinese pause, but the initial pause. It was because he said the bond market was getting a bit yippy. Well, it's yippy yappy, right? It's still, doing what it was doing. It's just not as quick. It was a sharp collapse back then. But now it's back at the same level. And I think it's getting ready for another sharp collapse. I think the yield on a 10-year treasury can move from 4.5 to 5 very, very quickly. And that's going to be a big problem, especially when Donald Trump has made it clear in his entire administration that one of their main goals is to bring down interest rates. Well, interest rates are going up. And even if Powell caves and cuts short-term interest rates, long-term interest rates are going to rise. After all, they rose after the first few cuts. Why should they not rise if he cuts more? I think the only thing that could temporarily stop the rise in long-term rates is going to be a return to QE. And they're not even, close to discussing that right now. In fact, they're still doing quantitative tightening. They haven't even stopped that. They've tapered it back, so they're not doing as much of it, but they're still doing it. And the other market that hasn't recovered anywhere near its losses is the dollar. Yes, the dollar index has recovered somewhat. It's back above 100, but barely. The dollar index right now is at 100.7. Yes, it did dip below 98 one day, but I think the dollar index was up around 104 or 105 before Liberation Day. So the dollar has been marked down and bonds have gone down. Yeah, we've got a rally in the stock market, but I think that it is meaningless. Yes, we got some people that got short. They covered. Some speculative money came back into the market. I think we're getting ready to roll back over. I do not expect the market to make new highs. I think it's more likely that we make new lows. Now, not when I'm talking about new lows, not record lows, but we take out the post-Liberation Day lows. I don't think those lows are it. I don't think that's the low of this decline. I think we're going to go lower, and we may go quite a bit lower after this bounce runs out of steam. And maybe it already is running out of steam. I mentioned on the last podcast that Bitcoin didn't seem to be going along for the ride, and that's continued. Even though the stock market has rallied over the course of the week, Bitcoin has not. I mean, Bitcoin right now is around 103 and change, and that's where it's been. It hasn't made a new high, and it's kind of been going sideways, and maybe it's about to roll over. It got some good news in that Coinbase was added to the S&P 500 and rose about 20-30% over the first couple of days, although it was down today quite a bit. Apparently, it's got hacked. I forget how much money it lost, several $100 million from a hack. And now there's some other allegations about Coinbase's numbers. I think it's interesting that this is happening after Coinbase was put into the S&P 500, not before. I think this is going to be a mistake for the guys over at S&P because I do think that Coinbase is going to be adding quite a bit to the losses for the S&P. But I mentioned that Bitcoin kind of led risk assets higher, and now it looks like it may lead them lower. Bitcoin bottomed before the NASDAQ, and it looks like it may have topped before the NASDAQ as well. And, I was listening on CNBC. I was listening to an interview with Jim Chanos, who mentioned that one of his big shorts was MicroStrategy. And I think that's a great short. But he also mentioned that he's hedging it because, he likes to hedge his bets. So he's long Bitcoin. He's not long Bitcoin because he wants to own Bitcoin. He just wants to limit his risk in being short MicroStrategy. Because if Bitcoin goes up, well, MicroStrategy could go up too. But ultimately, Bitcoin's going to crash a lot more. I mean, MicroStrategy is going to crash a lot more than Bitcoin because MicroStrategy is trading at a big premium to Bitcoin, and MicroStrategy has a lot of debt. And MicroStrategy could be forced to sell its Bitcoin at a very inopportune time, at a very inopportune price. So he owns Bitcoin, but not because he wants it, but because he wants to limit his risk in his short position, which prompted me to finally concede that there is, in fact, a use case for Bitcoin. I've been downplaying the fact that, hey, there's no real use case for Bitcoin. Nobody needs it. Well, yes, there is a use case for Bitcoin. You could use it to hedge your short position in MicroStrategy. So there you go. Michael Saylor has ironically actually created a use case for Bitcoin. You could use it to limit your risk when you short MicroStrategy stock. Now, obviously, that's not the use case that he had in mind. By the way, I am going to be appearing at the Bitcoin conference in Las Vegas. So if any of you are going to be there, I guess it'll be interesting to see what happens. Hopefully I make it out of there alive. But anyway, that conference is May 27th to the 29th. I talk on the 28th. And it's basically it's like a half hour. There's so many people there that you don't really have a lot of time. Although I am doing another event that it's going to be a couple of hours. So I have a secondary event, but my main stage, Yakamoto stage, it's a panel, just me and one other guy. And we're going to kind of debate Bitcoin, I guess, Bitcoin gold, something like that. So it's for a half hour. So that's going to be the time that I have officially allotted to me on the main stage. I do have something else that I'm doing kind of unofficially. But this was the first time that I've been at one of these events. So we'll see. But I think that the specter of this Bitcoin conference is also probably causing some buying of Bitcoin, because people probably expect that the conference will generate a lot of publicity, a lot of hype. And so people like to buy Bitcoin into that hype so they can sell it. And it's normally a buy the rumor, sell the fact. So maybe we'll get a big dump in Bitcoin, either during or maybe just before the conference. I mean, people may try to, get ahead of it, and they may not even wait for the news to start selling. There could be a sell-off even before the conference begins. But my point was, I think it's significant that the risk appetite is waning, and you can see that, most pronouncedly in Bitcoin, which is the riskiest of all the risk assets. And so if people's appetite for risk is diminishing, you would see it there. Now, of course, while the stock market was rallying, and gold pulled back. Gold had about a 10% pullback. Gold almost got above 3,500. And this morning, it was well below 3,200. In fact, at one point overnight, gold was down about 20 or 30 bucks. And that was following about a $70 decline yesterday in gold. In fact, I was watching gold in the morning, and it was down about $15 or $20. And then over about a 2 or 3 minute period, it got clobbered by like another 50 bucks. No news. Nothing happened. Somebody just decided to dump, a shitload of gold, at 6 a.m., 6:30, whatever the time was. And the price just got killed. And it pretty much stayed down all day. And then it went down a little bit more last night before it had a big reversal. Gold was up about $60 today. So about $80, $90 off of its low. And so I think today marked the bottom of the gold pullback. So I think it's over. And, gold's now, 3,200 and change. Let me see where it is now, 32.35. And I think the bottom is in. Now, it's possible we can go a little bit lower, but I don't think so. I think 3,000 is the new 2,000. If you remember when gold was above 2,000 initially, and I said 2,000 is the floor, you got to buy it. Well, now 3,000 is the floor. You got to buy it. It's, we're not that far above the floor at 3,200. You're not that far above 3,000. If we make another 50% move, which I think we could easily do, which is what we did from 2 to 3,000, that takes from 3,000 to 4,500. Well, we're a hell of a lot closer to 3,000 than 4,500. So you should buy it. But of course, the best thing I think to buy of the metals is silver, because silver is still around $32 an ounce, $32.70. When gold was at 2,000, silver was about 30. And I remember when silver first got above 30, I said, okay, 30 to silver is 2,000 to gold. And I was right in that silver didn't go back below 30, just like gold didn't go back below 2,000. But then gold went way up and silver didn't. You had a 50% rise in the price of gold, but barely a 10% rise in the price of silver. So if you missed out on $2,000 gold, just buy silver, because as far as silver is concerned, gold is still 2,000. Anyway, you can buy both metals at Schiff Gold. So just go there and fill up your cart or talk to one of my reps. It's not called Schiff Silver, but maybe I'll have to rename it one day because I am very bullish on silver. I'm bullish on both, but it's because I'm so bullish on gold that I'm even more bullish on silver, because I know eventually if gold keeps going up, silver is going to catch up, not to the price, but it's going to catch up percentage wise and close that gap. It's not going to be 100 to 1 at a minimum. My target is 50 to 1. And so at 50 to 1, that means the price of silver doubles relative to the price of gold. But that's not just going to be a double, because the price of gold is going to keep going up. So silver is going to double relative to a gold price that's much higher than the current price. Anyway, we got a quick commercial break. We'll be right back. So stick around. I got more to talk about. All right, before I forget, I want to make a couple of other announcements. I mentioned that I was going to go to the Bitcoin conference. Well, a couple of weeks later, I'm going to be making my first appearance in a few years at Freedom Fest. I used to go every year. In fact, I went from the very first year they had Freedom Fest, and I went quite a bit. But more recently, I've been traveling a lot during the summers, and I haven't had the time to go to Las Vegas, in July, which is when Freedom Fest typically is. Well, last year they had it in Nashville, but I had plans and I couldn't make it. But this year they're doing it in Palm Springs, California, just a couple of weeks after the Bitcoin conference. So my plan is after the Bitcoin conference, I'm going to be out in California for a while, and then I'm going to go to the Freedom Fest in Palm Springs. So that's going to be June 11th through the 14th. If you want to join me, you can go to, the Freedom Fest website. I've always had a good time at that conference. There's a lot of cool people there. And if you haven't been, you should, try to go. And if you've been, well, then you know what I'm talking about. Maybe you want to go again. I'm going to be giving several talks. We have a booth. In fact, we actually have a booth at the Bitcoin conference. Hopefully it doesn't get vandalized. But we also have a booth at at Freedom Fest. So I'll be there with my whole family too. My wife is going to be there with me. So we look forward to seeing you again. Go to freedomfest.com. If you want to sign up, you can, you got to buy your tickets or register, and you can, get yourself a hotel. I mean, if you live in California anyway, I mean, you could drive out to the desert. But if you're not in California, obviously you gotta make some plans in advance, get your flights. Oh, by the way, speaking about my wife, I also wanted to mention that my wife came out with a new YouTube video for her latest song from her album, Funny Money. Remember, she formed a singing duet with the former guitar player from Third Eye Blind, and they're called the Laughing Cats. And the fifth song that they've now released, and all the songs are up on her Spotify account, Laughing Cats. But this one is Love on Fire, and she's got a new video, which I don't know if we're going to play a clip of it, but I'm going to put the link to this YouTube video in the description and of this video. So when you're done watching or listening to my podcast, if you're on YouTube, check out her song. Her video. She worked very hard on it. She did it all by herself. She did all the editing and put it together. I mean, she hired some dancers to work with her and somebody to film it, but that was it. And she wrote the song, sang the song, and completely created the entire video by herself. So check it out. If you like it, leave her a comment, let her know. If you don't like it, I guess keep your opinion to yourself. She gets enough hate from some of the Bitcoiners that post. Oh, one more thing while I'm talking about my family. I just finished signing a bunch of my father's books. Two of them. One of them is The Kingdom of Maltz. This is a great book. One of my favorite stories that my dad wrote. It actually came from his book, The Biggest Con, which if you can get a copy of that, I don't have any copies. I wish I had more. I have a few, but I'm not selling them because that's all I got. But this story was originally in The Biggest Con. And my father's initial publisher said, it's too much, Irwin, take it out. So it got X'd out. But then the first book my father ever published when he started his own publishing company, Freedom Books, was The Kingdom of Malts. So he took the story that never made it into The Biggest Con, and he made a book out of it. And I love this book. It's a great book to explain money and inflation. Every American should read this book now because hardly any of them understand money or inflation. And so we still have copies. I'm not going to have these forever because I had several boxes and then they're gone. I mean, they're out of print. These things were printed, I think, 25 years ago. When my father first printed it, they were $2.50 a book. And when he reprinted it, it was $10. And this is in, 1980 was the original book. And I think this came out around 2000, maybe a little earlier than that. So it's over 25 years old. I mean, this was printed, right? It's brand new because it's been sitting in a box for 25 years. But we don't have that many of these boxes. So we're selling them. I autograph them. So you'll get a Peter Schiff autograph of an Irwin Schiff book. The other book, How an Economy Grows and Why It Doesn't, that my father also self-published, that came out of The Biggest Con, but that story was left in. It was part of the original book. That's the book that my brother and I based our book on, How an Economy Grows and Why It Crashes. So you can get your copy of The Kingdom of Malts at schiffbooks.com. And also my dad's book, The Federal Mafia, this one right here. This is the third edition, I believe, of The Federal Mafia, or 2003 edition. But I think it's the third cover because he had two other covers. This was the last one. So it has all of his most recent stuff. Of course, again, it's about 25-year-old book or something like that. But the interesting thing about this book is other than Fannie Hill, it's the only book the federal government has ever banned. My father was banned by the government from selling this book. And that had only happened one time in all of American history. And that was Fannie Hill, which was ruled to be pornographic. And so it was banned because of obscenity. By today's standards, I mean, it'd be a comic book. But back in the day, it was considered offensive. But the only other book that was banned is this one right here, The Federal Mafia. So I think it's worth having for that reason alone. But it's a great book to read, understand my father. I sign it. Again, when I tell people to buy the book, The Federal Mafia, it's not because it's a how-to guide on how to stop paying your income taxes. I'm not advocating that at all. And in the book, my father does, recommend that you could stop paying your income taxes. So I'm not recommending that. I'm recommending that you read it for an educational experience, not for tax advice, but to understand the unconstitutionality of the tax code and the tax law, and to understand, my father's position that he took, and that he died in jail defending. He never was broken by the government. He stuck to his principles until his dying breath. So I get a copy of that book. And if you want, you can get both of them. I just signed a whole bunch. So we got them here in Puerto Rico and they're ready to ship out. So you got my dad's books, you got my wife's YouTube video, and then you can see all of us, not my dad, but my wife and I and my kids will be at Freedom Fest and the Bitcoin conference. We're going to be at both of those events. Anyway, so a few more things I want to talk about. One, I want to backtrack to my podcast from, I think, Sunday night. And I talked about Trump's, price controls on drugs, trying to enforce this most favored nation status, saying that, U.S. drug companies can't charge Americans more than they charge their best overseas customer, the lowest rate. And I know that I talked about how, look, the real problem is the FDA. That's what we need to go after. And that's not what's happening. And the reform that I suggested, one of the easiest ones, is to remove the requirement that companies prove efficacy, right? You don't have to prove your drug works, just prove it doesn't do any harm. And if the drug doesn't harm you, then let anybody who wants to try it, try it. I think it's ridiculous that you have to prove that the drug works. Because what if it does work and it takes you years to prove it? People are dying who might have been saved. And of course, there are a lot of drugs that may work. They just can't prove it. Maybe that, the tests just weren't conclusive. It was a close call. And they don't get approved. But it's possible that the drug may have worked on some people. And if it didn't work, all right, well, it doesn't harm you. If it doesn't hurt you, then why can't you try it? And of course, a lot of it has to do with the doctors. I think the doctors, before they prescribe a drug, right, they're going to be pretty certain that the drug works or has a reasonable probability of working. Otherwise, they're not going to prescribe it to their patients. So I would rather allow doctors to make that call rather than the bureaucrats in government. And oftentimes, the FDA ends up getting controlled by the companies that it regulates. And a lot of times, if I'm a drug company and I got a drug, and somebody else comes up with a competitive drug, if I've got some political pull, I can influence the FDA to reject a drug. Especially if it's a drug maybe that doesn't have any side effects, because maybe I've got a drug that does something, but it has all kinds of side effects. And what do you know? I got more medication to deal with the side effects. So I make a lot of money if you use my drug, and then you got to buy my other drugs to deal with the side effects of my first drug. Well, what if someone else comes up with a drug that doesn't have any side effects at all? That's a real threat to my business model. Well, all I have to do is grease a few palms at the FDA, and maybe that, application gets rejected. So it's so easy to reject something because a lot of it, when they review the data on efficacy, it's a judgment call. They decide, all right, does it work or doesn't it work? And it's easy to influence their decision because there's so much politics involved and there's money involved. So I want to get rid of it. We didn't have it until 1962. It's not like people were dropping dead or they were just, taking all this voodoo medications, because, you could sell what you wanted and everybody was just selling a bunch of snake oil. I have more faith in the free market than that. But, one of the examples that I used to use on my podcast years ago had to do with sunscreen. And this shows you how ridiculous the FDA is. So America leads the world, I think, in skin cancer. We have more cases of skin cancer than anybody else. Now, what would be, a good thing to help reduce skin cancer? Well, that's sunscreen. And they've got sunscreens all around the world that are very effective at reducing skin cancer. They really knock out the rays that cause the cancer. And you can buy these sunscreens in any country in the world except America. Now, why can't you buy this great sunscreen in America? I mean, we have sunscreen, but we don't have the good stuff. You want the good stuff, you got to go out of America. In fact, I remember after I mentioned this the first time, one of my fans lived in Israel, started sending me all this Israeli sunscreen. But I even found out about it, when you're traveling. I mean, if you're ever going to go abroad, don't bring any sunscreen. Just buy sunscreen when you get there because it's way better than the crap that we got. Now, why is it that there's this great sunscreen that you could buy all around the world, but Americans can't buy it? Because we can't get it approved by the FDA. Now, why? Well, the companies that make the sunscreen don't think it's worth the extra money to have to prove to the FDA that the stuff works. And so rather than spend all that money to prove that the sunscreen works in reducing cancer, because they'd have to do all these studies, random, double blind. I mean, it would be a big deal. And it's not worth it because it's just sunscreen. I mean, it's not that expensive, right? And so the drug companies, or not the drug companies, the makers of sunscreen just said, you know what? Screw it. We're not going to spend all this money. So we're not going to sell the sunscreen in the United States. And so what happens? We use crappy sunscreen, and now we get a lot more skin cancer than other people who get to use the good sunscreen because their government regulations aren't screwing it up and making it so expensive to put the sunscreen on the market. So the real reforms, what we need to go at the FDA. And there's a lot of other things with healthcare. I mean, one of the most important things I think we can do with healthcare is separate it from employment. You know, why do so many people get their health insurance from their employer? That really started during the wage and price controls era of the 1970s. Because when they initially put in price controls, you couldn't give your employees a raise, but you could start giving them health insurance. That was a way around the wage controls was, well, okay, we'll throw in health insurance. But also the big thing about it is if your employer pays you in health insurance instead of cash, it's tax-free. So let's say health insurance costs $10,000 a year. I'm just making up a number. And your employer pays you $10,000 and then you go and buy your health insurance. You don't get $10,000. You got to pay taxes on that $10,000. So maybe you got $6,000 left. Well, you can't afford the health insurance because it's, $10,000. But if your employer doesn't pay you the $10,000, if he just gives you the $10,000 insurance policy instead of the cash, you don't have to pay any income taxes on that. Right? So the government has said if you accept cash for your work, you got to pay taxes on the cash. But if you accept health insurance, it's tax-free. Well, of course, then everybody wants to get their health insurance tax-free. So now everybody gets their insurance from their employer. Now, the problem there is you lose your job. Well, you lose your insurance. So how do you get rid of that? Change the tax code. Stop giving people tax-free health insurance. Lower the rates on everybody and make health insurance taxable, just like cash. So now people will go out and buy their own health insurance, which means if they buy their own health insurance, if they lose their job, they keep their insurance. And they don't have to worry then about pre-existing conditions because they're not getting a new insurance policy every time they get a new job. They can keep their insurance policy for all of their lives. Plus, I think people will shop around more, but also because people get health insurance tax-free, they tend to be overinsured because you're getting it for zero tax. So yes, give me the Cadillac plan because it's tax-free. But the minute you had to buy your own health insurance with after-tax money, people will say, I don't really need the Cadillac plan. I'll take the Ford, right? I'll take a plan with a high deductible and a higher copay. And that would be a good thing because you have a moral hazard. When you have a third party paying for everything, you overutilize healthcare. When you pay more of your own costs, then you control the costs. It's like if you went and bought auto insurance and the auto insurance covered gasoline, right? You drive like a maniac, right? But no, your auto insurance doesn't cover the gas. So, you might be economical in how you drive your car, right? Because you got to pay for the gas. But if the gas was free, if the insurance company covered your gas, right? Well, you probably end up using a lot more gas, right? So the insurance company is there in case you get into an accident, you trash your car, right? And it's really expensive and you need to buy a new car. So what people should do with health insurance is you don't have health insurance to cover checkups, to cover routine care. Like, you get the flu, you got to go to the doctor, or even, you sprain your ankle, little things like that. Even you should be paying out of pocket. Insurance should be for catastrophic outcomes. My father used to sell this major medical policy back in the 60s. And I forget, I think he said it was like a $5,000 deductible before it would kick in. And he said, and all the time he was selling the policy, he doesn't even remember anybody ever meeting the deductible because nobody ever had $5,000 worth of medical bills in 1 year. But the whole idea was, if you really got sick, you got cancer, got a brain tumor, like you need, major surgery and you don't have the money. That's what health insurance was for. I mean, it wasn't even for childbirth. I mean, if you were pregnant, you just paid for it. Back in the day, people didn't have insurance to cover the cost of pregnancy. That was just routine. You're married, your wife's going to get pregnant, so you save money and you pay for the childbirth, right? Insurance is not supposed to insure against things that you know are going to happen, right? You buy fire insurance in case your house burns down. You don't expect your house to burn down, right? And in fact, if the insurance companies knew your house was going to burn down, they wouldn't sell you an insurance policy. They're only selling you the insurance policy because they know it's not going to burn down, right? They count on a lot of houses not burning down. That's where they get the money to cover the ones that do. But everybody buys health insurance now because they want the health insurance companies to pay all their medical bills. Every time they go to the doctor, they want the insurance company to pay for it. That's not insurance. Insurance is to cover the things that aren't going to happen, that you don't expect to happen. You're supposed to waste your money on your insurance, just like you buy fire insurance and you hope you never use it. You buy auto insurance and you hope you never use it because that means you got into an accident, right? You're supposed to buy health insurance and hope you never use it. No, people get health insurance and immediately start using it. That is why healthcare is so expensive in this country, because we've got a third party paying for everything, right? Again, if the insurance companies paid for your gas, the gas stations would jack up the price because you wouldn't give a damn what gas cost if the insurance companies were paying for it. Try to even ask. You go to a doctor today in America, and they're gonna do a procedure. Try asking how much it's gonna cost. They don't even know. Nobody knows how much stuff costs because nobody cares, because the person who's getting the procedure doesn't pay for it. Some insurance company pays for it, right? No one knows. So there's no free market forces that are keeping prices down. And it's so easy to see this because if you go and you look at the areas of medicine that insurance doesn't get involved in, like eye LASIK surgery, the price is a lot lower today than it was 20 years ago. That's not true for basic medical care that insurance covers. Everything is way more expensive. What about cosmetic surgery? A nose job, breast implants. This stuff is cheaper than it used to be, right? Why? Because, your insurance doesn't cover this stuff. So when women want, breast implants, they shop around. They actually ask, what's it going to cost, right? But when you're going in for, other types of surgery, nobody shops price. Nobody cares, right? It doesn't matter what it costs because you're not paying it if you got insurance. So these are the things that Trump should be working on. Free market solutions to government created problems instead of trying to use government to enforce a price controls, which has got nothing to do with why drugs are cheaper in Europe than they are here. It's got everything to do with the FDA and our own policies. But I also wanted to talk about the big beautiful bill. Oh, before I do, I meant to say this when I was talking about Bitcoin, but I noticed there was on a financial channel, there was a woman covering financial news, and she was talking about gold and Bitcoin. And so when she talked about gold, she called it physical Bitcoin. She said, let's check the price of physical Bitcoin gold. So in other words, in her mind, Bitcoin is gold. It's just gold in its digital form. And actual gold is just a physical form of Bitcoin. I mean, now we've really gone off the deep end and jumped the shark when it comes to the financial coverage of Bitcoin when they're calling gold physical Bitcoin. I mean, that's even worse than calling Bitcoin digital gold because it gives Bitcoin a top billing above gold. But anyway, so I want to talk about this big, beautiful bill that's big, all right. So they've got that part right. And it is a bill until the president signs it into law. We know that from that song from the 70s. Some of you might not know that about how a bill becomes law. Schoolhouse Rock. Check it out on YouTube. Maybe it's still up there somewhere. But it ain't beautiful, right? So 2 out of 3, but it is bad when the one that you didn't get is the beauty. It's a big, fat, ugly bill. And so one of the things that's not in the bill is higher taxes on the rich. They managed to kill that. I mean, Trump floated that trial balloon and it blew up. So the top rate is going to stay at 37%. It's not going up back up to 39.6. Of course, the hedge funds dodged a bullet again, and the carried interest loophole will not be closed. And, interesting, I was watching a guy, I forget which congressman it was. He was being interviewed on CNBC, and he was asked specifically about the carried interest loophole. And he was asked, to justify it. If you don't know what that is, it means the carried interest. So when you are a hedge fund manager, a private equity fund manager, the classic compensation formula is 2 and 20. The 2 is the management fee. 2% to manage the portfolio, up or down, get 2% off the top. The 20, right, is the back end compensation for performance. If I make you money, I get 20% of your profits. Right? That is called the carried interest. It's a carried interest because you didn't put up any money, right? The investors carried your interest. So you had no skin in the game. Now, of course, a lot of hedge fund managers do have skin in the game because they are investors in their own funds. Often they're the largest investor, which is something that you want, right? Before you invest in a hedge fund, make sure that the manager is got his own money in there, right? So he's got something at risk, right? And so the carried interest is a fee for services. It's the income of the manager. And that carried interest is not taxed at the ordinary income tax rate, the rate that's applied to that 2% management fee. It's taxed as long-term capital gains, assuming that the gains that are generated are long-term capital gains. The question is why? Like, why is that? Like, why do hedge fund managers get this break? Because other people that earn money, even in the financial services industry, like I manage mutual funds, and the fees on mutual funds are taxed as ordinary income. There's no capital gains there. And so why is that? And even if you're we manage separately managed accounts, and we are allowed to charge a percentage of the profit. So I can charge somebody 10% of the profits for managing their account, but that 10% of the profits is not capital gains. It's ordinary income. But of course, there are a lot of other people, doctors, lawyers, and bankers. They earn high salaries and they pay ordinary income tax rates. So why are these billionaires paying 24% tax? Right? What's so special? Why is it so important to create additional incentives for them, but not for everybody else? So the guy asked this question to the congressman, and all he can say is, "Well, we don't want to raise taxes on anybody." And that wasn't the question. He asked it again. I said, I didn't ask you that question. I want to know why we need this special break for hedge fund managers. And again, the congressman said, well, we don't want to raise taxes on anybody. And that's because he has no explanation. There is no reason that we have to give these guys a tax break. I mean, they would work even if there was no lower tax, right? Just like anybody else. The real reason that the hedge fund managers have this tax break is because they pay for it. They have a lot of clout on Capitol Hill because they donate a lot of money to the campaigns of a lot of key congressmen and senators to make sure that they never remove this provision. I mean, let's say the hedge fund industry in total earns billions of dollars a year off of this tax loophole. Well, they're going to spend millions, tens of millions, maybe hundreds of millions to keep it. So they give all this money to the politicians, and that's why it never goes away. I mean, you hear all these Republicans and Democrats, they want to go after the millionaires and the billionaires, even the Democrats. Even when the Democrats had the House and the Senate and the White House, they couldn't get rid of the carried interest loophole that they all want to talk about how terrible this is. We got to get the millionaires and the billionaires. Well, not on the carried interest, right? Because they've got the politicians in their hip pockets on that. One of the provisions of this bill, which I think is a very bad idea, and it's an idea that Donald Trump came up with, and so it's in there, is the 10% deductibility, or you can up to 10,000. You can deduct on your income tax the interest that you pay on an auto loan, as long as the car was assembled in the U.S. Doesn't have to be manufactured here. It's got to be assembled here, right? Because a lot of the parts are imported. But you can deduct the interest on the car loan. Now, why is that? Why does the U.S. government want to subsidize people to go out and borrow money to buy cars? That's a bad idea. It's bad economic. I mean, first of all, I don't like the fact that people take out car loans. I think that you should buy the car that you can afford. And if you don't have the cash to pay for a car, then buy a cheaper car. Buy a used car. Don't buy a brand new car and finance it if you can't afford to pay for it. Because the financing really increases the cost of the car, number one. But, it's not a good reason to borrow money. Just buy a used car. Pay cash, right? But, if you want to do that, if you want to go out and take out a loan and buy a car, okay, it's a free country. But the government shouldn't encourage it. The government shouldn't subsidize it. And that's exactly what they're going to be doing. Because the minute you give out this tax deduction, people are going to borrow money that might not have borrowed it, and they're going to be incentivized to borrow even more, because they're going to look at the after-tax cost of the car loan. And because the government is going to be giving them a tax deduction for the interest, they can afford to pay more in interest. They can afford to buy a more expensive car and borrow more money. And this is not what we want to encourage. Donald Trump says we need to manufacture more. We need to produce more. Exactly. So we don't want to squander our savings on consumption. And when you borrow money to buy a car, right, that's not a business loan, right? That's consumption. Now you can say, well, people need a car to get to work. That's true. You don't need an expensive car to get to work. You just need a car that works. So you don't have to buy, a new car and take out a big car loan. You can buy a used car for $3,000, $5,000. They're there. They're on the market. Buy yourself a 15, 20-year-old car if that's all you can afford. You can get back and forth to work and save up your money. And when you save up enough money, then buy yourself a nicer car. But, this shows you it's just not that the Democrats that have all the dumb ideas. But why do the Republicans want to do this? Because it's popular. That's the populist aspect of Trump. Yay, let's give you guys a break, right? So we'll make it easier for you to borrow a car. Buy a car by borrow money. We'll make it tax deductible. That's a giveaway. See, the government likes to pretend they have something to give away. The government doesn't give away, it takes, right? It has to take before it can give away. And no one says, okay, so the government's going to give us a tax break when we borrow money to buy cars. So now the government's going to lose out on some taxes. So where are they going to get the money? They're going to borrow. Investment accounts for newborns. So when a baby is born now, according to the big, beautiful bill, the government is going to put $1,000 into this account that's set up for this baby. Well, where's the government going to get the $1,000? The government's broke. So the government's going to borrow money that little baby is on the hook to repay and give the baby that $1,000. You know what a better gift is? Pay down the national debt so that baby isn't born in indentured servitude. So that baby, right, doesn't have to deal with mountains of debt. I mean, the government is acting like, oh, yeah, we really care about these newborn babies. We want to give them $1,000. Yeah, you're giving them hundreds of thousands of dollars in debt. That's going to more than offset that puny little $1,000 that you borrow to put in that account. So if you care about the newborns, then veto the big, beautiful bill and actually cut some spending. the Republicans are saying, oh, we have some cuts to Medicare, right? We have these work requirements, right? We're cutting Medicare. Well, you know when they kick in? In 2029. 2029. This is 2025. Why are you writing a bill and passing it in 2025 where the spending cuts don't kick in for 4 more years? I mean, why don't they just start right now? What's wrong with 2025? If you're going to cut spending, then cut it right now. The reason that spending cuts never happen right away, the reason they always happen in 4 years, right, when Trump's no longer president, the reason that they do that is so nobody actually feels the pain of the spending cut and to give Congress enough time to eliminate the cut before it actually goes into effect. And so this is all smoke and mirrors. The Republicans in Congress today are blowing the same smoke up the butts of the American public as they've been doing all along. These are phony cuts. And, you know, the Democrats are making a big deal about these phony cuts. Oh, Republicans, you guys are cutting. You guys are throwing grandma off a bridge, right? You guys are cutting, you know, so they're taking all the heat for nothing. The cuts are phony. I mean, if you're going to take the heat, then at least make the cuts, at least have the guts to actually cut. I mean, pretending to cut makes no sense, especially when you're going to be taken to task by the Democrats for cuts that you didn't even make. Now, a few other things that are in there. You know, there's the no tax on tips, no tax on overtime, and it's not really no tax, you know, because the biggest tax that most people pay on their tips is not the income tax, it's the payroll tax. And the payroll taxes still apply, the Social Security tax. So if you're self-employed, you really feel it. So if you're a self-employed Uber driver and you get a tip, you still got to pay the 15% self-employment tax on that tip. You just don't have to pay the income tax on the tip, but you got to pay the self-employment tax. Now, there's all sorts of other rules in there to try to limit abuse, because obviously, once the government says there's no tax on tips, well, now people have an incentive to be tipped as opposed to just being paid. So people will find ways around that to reclassify income as being tips. And so they're trying to find ways to prevent that. But of course, they'll never find ways to prevent it all, right? And what they leave open is going to be called the loophole. So of course, no tax on tips is going to end up costing the government more money than they think, because all of a sudden, a lot of people who haven't been getting tipped are going to get tipped, right? They're going to find ways to exploit the fact that if you get paid a tip, there's no tax. Just like I said with health insurance. If you get paid health insurance, there's no tax. So I don't want cash where there's a tax. Give me my health insurance. And so people are going to find ways to get tipped. They're limiting it in some respects, right? It's not a free-for-all, but there's going to be enough room there for people to abuse it. There always is. The same thing with overtime, right? Now I can get more money if I work overtime. Great. There's going to be an increase in the amount of overtime. And remember, overtime is on a weekly basis. So let's say I got a 40-hour-a-week job. If I work 40 hours every week, I don't work any overtime. Well, what if I rearrange my schedule? I work 20 hours one week and I work 60 hours the other week. I still work 80 hours over 2 weeks, but now 20 of my hours are overtime, and now there's no tax. So people will find ways to rearrange their compensation. Now, the employer might have to reduce the wage if overtime is time and a half. So he may have to reduce the wages so that the employer is not out of pocket any extra money. He's still paying the worker the same amount of money, even though he's working 20 hours one week and 60 hours the next. But now the worker's got more take-home pay because he's not being taxed on 20 hours of his income. So all this stuff's going to happen. So the tax breaks are going to end up costing more than the government thinks. And so the increase in the deficit, and they already acknowledge this bill is a deficit buster, right? The cuts in spending pale in comparison to the cuts in taxes. And again, they don't even kick in, right? The big Medicaid cuts, again, they kick in 2029, so they don't even count. They're not going to count in 2026. They're not going to count in 2027. And they probably won't count in 2029 because in 2028, they'll get rid of it, right? Because, oh my God, we have to stop these cuts from coming into place. We have to act now or there's going to be cuts to Medicaid, which so that's what's going to happen. And so the deficit is going to go up. And so I was right about this from the beginning. All this talk about Doge coming in there, cutting $1 trillion, $2 trillion, none of that's going to happen. The debt is exploding. The deficits are exploding. The big, beautiful bill that Congress will pass and that Trump will sign is going to have bigger deficits and more government spending than what we had under Biden. Now, that doesn't mean that we wouldn't have had even bigger deficits and more spending under Harris. We would have. But what it means is that nothing has changed, that we're on the same trajectory. We're still headed over a fiscal cliff. We're going to have a U.S. dollar crisis. We're going to have a sovereign debt crisis. And that has been amplified by what we've witnessed over the last month or so with the reaction to the tariffs post-Liberation Day. So this is, I think, what the world is now going to pay attention to. The distraction of the trade war is over, but now we're focusing on the budget deficits rather than the trade deficits. Both of them are exploding. The dollar's days as the reserve currency are numbered. And so that means you have a finite amount of time to diversify yourself. Yes, the world is getting rid of the dollar, getting rid of U.S. assets. Americans need to do the same thing. We need to make the same trade. So again, go to my reps at Europe Pacific Asset Management, Europac.com, and talk about the strategies that we have and how you can incorporate those into your portfolio, and read about some of the ideas that we have at Schiff Sovereign. If you haven't already signed up, make sure and get the free subscription at schiffsovereign.com. Bye for now.